Hey there, it is Corey here from Verse. I hope that you are going really well and are happy and healthy. To all of our Victorian clients that we know are still in lockdown, that does include Ash, I, and a good chunk of our team. We know you're probably feeling a wee bit of lockdown fatigue. I definitely am. Hopefully soon enough, we are enjoying some of the freedoms that the rest of the country have been enjoying for a while. But keep your heads up. Today, we do have a market and economic update for you. And when I say we, that is myself and Ashley Bishop, one of the financial advisors here at Verse Wealth. Ashley, it is nice to see you on Zoom again, as always. Thank you for joining us.
Thank you, Corey. Yeah, nice to see you over Zoom as well. Interesting note we were talking about that people might enjoy. Since I started Verse, spent about 10 weeks with you guys in the office and worked out around 20 weeks working from home. So you, to me, mate, are a head on a screen. Look forward to seeing you again in person at some point. But yeah, at least not for the next 2 to 4 weeks, it sounds like.
It's going to be a little while. Zoom is kind of how we live now, right? We've probably done 1,000 Zoom sessions together in the last 5-6 months, and I think we've got a few more to come. So let's make this one a good one, Ash. There's a few things that we're going to touch base on today that you're going to share with our clients out there. The first one is the guidance we got last night from the US Federal Reserve. I'm going to get you to explain what that was and what that means for everyone out there that's investing money in or out of their superannuation. You can give us an update on investment markets. We did see, I think it was early last week, the US market return to record highs, which is quite stunning given the state of the economy, the US election, and everything else that is going on with COVID-19. So you can tell us what's happening there and what is driving that phenomenal recovery. You'll give us an update on the Australian market as well, which isn't quite at record highs, but has seen a really strong rebound since the lows of mid to late March. And you can tell us what impact COVID-19 might be having or may have on the Australian market as well. So let's dive into that guidance that we got last night from the US Federal Reserve. Ash, step us through what that was and what it actually means.
Yeah, thanks, Corey. So it might not sound like it, but last night was a relatively historic night in terms of, I guess, financial market, because the US Federal Reserve gave us a bit of guidance on their thinking around inflation. Now, for those who sort of don't know, the US Federal Reserve is effectively the equivalent of the Reserve Bank of Australia over here. So they set like interest rate policy, for example, similar to what the Reserve Bank does here. So, for example, in Australia, they've set the interest rates at 0.25%. The Federal Reserve over in the US has the same role. They also complete what's called quantitative easing, which is where they're going out and buying government bonds in order to maintain liquidity in the market. So that money goes out and gets, in theory, borrowed and invested in the market, the same as the Reserve Bank of Australia does here. Now, in terms of that sort of historical announcement, what the Reserve Bank has said is that, sorry, not the Reserve Bank, the Federal Reserve, my mistake. What they have done is basically said that they are no longer aiming for the same inflation target that they were previously. Now, inflation, for those who have probably seen it in the news pretty regularly, what it measures is the changes in costs to the everyday goods and services that we purchase. You may have heard the term CPI as well, so Consumer Price Index. That's what that is. So when goods increase in price, we have inflation. If we have a reduction in price, we have deflation. The aim for example, over here in Australia with the Reserve Bank, the aim has always, well, not always, but most recently been between 2 to 3%. That is the point where it is considered that that's a healthy rate of growth for the economy, because what traditionally economists don't want is deflation, where the price of goods is decreasing. The reason they don't want that is because if you have deflation, the price of goods are reducing, so people are more likely to hold on to their money to wait for a better deal, which slows down the economy because no one is spending. So having that sort of 2 to 3% is considered to be an affordable rate of inflation. And over here, that's been the target and the role of the Reserve Bank to keep. In the US, they've been aiming for 2%. what the Federal Reserve has said is that they are no longer aiming for strictly 2%. They are willing to let inflation go higher than that for a sort of undetermined period of time, to make sure that the economy can continue to, well, not continue, but when it does recover, can sort of continue to work stronger, so people feel more confident investing. And ultimately that helps with jobs in particular. The reason for that, or why that is important, because if you allow inflation to creep above that 2% range, and you do so by leaving interest rates at that lower end. Traditionally, if inflation increases, you would increase interest rates to try and bring inflation down. Some of our older clients may have remembered times where interest rates were up in the mid-teens, as an example. The reason that was because inflation was getting out of control. They tried to bring inflation down using interest rates. If I share my screen, just to give you a bit of context about how this is going to work, you can see there I've got US inflation up at the moment. You can see it's around 1% recently, has been around that 2% band over the last 12 months. So it's been sort of in line with what the Federal US Reserve wants. But inflation has come down heavily in that time. It is expected to remain low for a longer period of time as well, simply because the economy in the US is struggling. There have been some recovery since the beginning of the pandemic, but ultimately it hasn't performed strongly. It's potentially not going to perform strongly if you still have the same environment in terms of COVID-19, continuing spread of infection, as you rightly pointed out, Corey, a US election as well. And ultimately, if we think of the US labour market as being a lot less secure potentially than the Australian and some other sort of developed nations, a lot of those employees have been furloughed, so they're unemployed at this stage and waiting for the economy to recover. So that's why we're possibly looking at a slower period of recovery. If I bring up a new slide here as well, because I want to show you what inflation looks like in Australia. So that chart has come up now. You can see here with the Reserve Bank of Australia
just before you dive in there, Ash, I can still see the US inflation chart.
Right, okay. In that case, let me bring up a new one. That should be the Australian chart now.
There we go.
All right. The new technique didn't work on this occasion, but we'll try it again in future. But ultimately, in terms of Australian inflation, you can see that it's been sort of right at that 2%, maybe a touch below target in Australia. And that is part of the reason as well why the Reserve Bank of Australia have kept interest rates really, really low. As you can see, really due to the COVID-19 spread and the shutdowns that have occurred mainly in Victoria, but in other parts of the country as well on a time-to-time basis. You can see that we're actually in a sort of slightly deflationary period, whereas prices are coming down. But how long that lasts, we don't know. Most likely scenario is that when Victoria does open up, hopefully we'll start to see some economic activity and an increase to inflation. But the point being there is that because inflation is just so unlikely to increase to those 2% plus levels for an extended period, the likelihood is that interest rates are going to remain at historic lows for an extended period. The Reserve Bank here have suggested that at least 3 years before that's unlikely to change. We're probably going to see the same in the US and around the world, in Europe as well, Asia, all of those sort of important areas for economic development. So when it comes to that, what's going to happen next is, as I say, we'll come on to in a moment, Corey, but the likelihood is that with lots of cheap money and interest rates at historic lows, getting a return on your cash and term deposits is going to be fairly difficult, which means that you're likely to see money moving towards share markets and other assets that are likely to provide maybe a little more growth.
Well said, Ash. In terms of those share markets, there's probably a good segue from you. I mentioned earlier that the US market has recently hit record highs, up more than 60% off its lows of March 23, when we saw that 35% fall due to COVID-19. Can you tell us a bit about, I guess, that recovery, but in particular, I guess the devil is in the detail in terms of that rise and being at record highs? Because there's a lot of businesses on US markets that are actually at lower levels than they were pre-COVID as well. So tell us a bit about that, and maybe also segue into that guidance from the US Federal Reserve around lower rates for longer and what that might mean for markets.
Yeah, absolutely. I think there's one really interesting chart that I saw in the last couple of days, which I'll bring up now. Now, you should be able to see that new chart there, which effectively shows the US, I guess, S&P 500, which is the top 500 companies in the United States by value. As you can see there, even though we'll come on to what that chart looks like, but the S&P 500 in the US has, as you correctly pointed out, reached record highs even since the pandemic. So a really strong recovery. But a lot of that's been led by, as you can see in this chart, around a third of actual those companies in the top 500. And in particular, your large tech stocks have done particularly well. So your Amazons, Microsofts, your Alphabet, which is Google effectively, your Facebooks, all of those companies have led the charge in a particularly strong way. Zoom, ironically enough, done very well also, which is I'm sure we're part of. But ultimately, you can also see there that 2/3 of those companies in the top 500 in the United States are actually below where they were back in February, which I guess depending on your point of view can be looked at two ways. One is that the economy is actually struggling in the US, but we kind of know that already. What it potentially also means, though, is that if the US economy does start to recover, now I'm not suggesting that's going to happen in the short term, and there are a lot of good reasons why that's probably months away. But in 2021, there are people forecasting that you'll start to see some quite strong recovery in the US. If that were to happen, you can see that there is a sizable number of companies that are just waiting for better economic conditions to potentially recover as well. And that's not to suggest that that means the other tech stocks and so forth are going to come off. Like, they'll still be operating. The working from home and some of the reasons that they have done very well are still likely to remain as well. But there are reasons to be confident in the US market going forward. But of course, there are also plenty of reasons in the short term in particular to be cautious. And like you correctly noted, as we talked about, COVID-19 is by no means under control over there. They have an election coming up, which is likely to be nasty and have a lot of sort of negative headlines come out of that. So potential volatility ahead, but as we mentioned, reasons to be optimistic into 2021.
A really, really interesting slide, Ash. And I guess that helps us understand why, if 2/3 of the market or the companies on the market are posting losses, some plenty in excess of that 20%, that 20 to 40% band that we just saw before, it just helps you understand that the performance of the market heavyweights, those largest companies with the biggest market cap on the market, Facebook, Amazon, Google, Apple, and Microsoft, in no particular order, when they do well, it has a huge bearing on the overall market, even if plenty of the market's still struggling. So thank you for sharing. Now, in terms of our market, maybe give us a bit of an update as to what's happening on the Aussie market. We do spend a lot of time talking about the US. As you said, it's the largest global economy. Our market makes up only about 2% of the total value of global share markets. In fact, Apple is now worth more as a company than the entire Australian share market, which is quite phenomenal to think about. So our market still matters, and it particularly matters to Aussie investors as well, and Aussie superannuants. So tell us a bit about what has been happening on our market, which has also seen a strong recovery, just not at the same levels that we've seen in the US.
Yeah, absolutely, Corey. So you're correct. We haven't seen the same level of recovery. And look, Australia doesn't, outside of Afterpay, which has outperformed all of those companies that we've just mentioned. So if you bought at $8 many months ago, then congratulations. But for those of us,
they were trading at $91 yesterday, I saw. So
they were, yeah, slight dip today. They're only 89 today, but look, they're doing very well. And but ultimately, for those of us with a slightly more diversified portfolio,
which is everyone,
hopefully. Well, that's it. Ultimately, in that case, you can see there that the Australian market has done well. There's no doubt about it. But after that initial recovery, which was fairly sharp in the shorter term, you've seen things not flatline, but certainly only increasing on a very incremental basis. The chart I have here is the All Ordinaries, so the top 500 companies in Australia. So the recovery's still been relatively strong though. So we're only around sort of 13% down now than where we were back before COVID-19 hit the markets. So, but again, we don't have those big sort of tech stocks outside, as we've mentioned, Afterpay, or that have sort of really run strongly in the market. A lot of this is really just sort of incremental improvements. Similar to the US, we still have plenty of companies that are well below where they were. The obvious ones being your airlines and travel stocks, like Flight Centre, for example. But you do have some success stories in terms of the companies that are most benefiting from working from home. So whether it was your sort of Wesfarmers or those sort of companies, Woolies and others that are doing well, but ultimately Australia's we're in a position where again we're uncertain about what happens. There's been a big drag on economic activity due to Victoria's lockdowns and the spread of COVID here. We are starting to see some optimism, or hopefully starting to feel some optimism for our fellow Victorians. But the fact, and we've talked about this previously, the fact remains that there are reasons to be optimistic. For example, Victoria reopening, it is a significant portion of Australia's economy. Some of those companies potentially doing better. If borders reopen, even the Australian border reopening to international travel, that's going to have a positive effect at some point. But of course, there are reasons to be cautious. So we don't know what's going to happen. Victorians assume they're coming out of lockdown in 2 weeks. Seems optimistic, but ultimately we don't know what's going to happen with the virus. So there are reasons to be optimistic, reasons to be cautious, but ultimately over the longer term, and like we talked about, Corey, this will end. The pandemic will end at some point by sort of vaccine or by herd immunity or however it happens. And over the long term, there are still reasons to be optimistic about Australian companies and the economy in general, but we don't know when that's going to happen specifically.
Absolutely true. There's probably never been more uncertainty, but I do know with certainty that many of the investment principles that we have been talking about with clients and on these updates in the last 5-6 months, and in all the months and the years in the lead up to this COVID-19 pandemic and market downturn, have all stood up and been validated. That concept that when markets take a crash in the short term, markets can rebound as quickly as they can fall. And moving to cash in the short term, although it might feel safe, is the riskiest thing you can do because you're going to miss the upside. And the fact that the market and the economy are not highly correlated, not always. And you can see an economy really struggling, but a market rising really quickly. The US is a wonderful example of that, as is our market as well. And then investing is always about the long term and making sure you have a good base level of knowledge and good expectations, and a lot of diversification means you can ride out these corrections and downturns and crashes, because this is not the last one and they're inevitable. You know, these conversations that we're having together that clients are listening to, and the conversations you're having with Ash or one of your advisors at Verse, they are to help build your knowledge so that when we go through these times in the future, you can get through them with as less stress as possible and as much conviction as possible. So I hope you've been getting value out of these market updates. Ash, we appreciate your rundown again, as usual. I hope you have a wonderful weekend. To all of our clients, we hope you all have a wonderful weekend. Again, to those in Victoria, keep your chins up. It will be over soon enough, and it will be a thing of the past. I, like you, am very much looking forward to when we can say that to be true. If you need us for anything, as you know, we are here. We've got your back. We are helping you live your best life by making the best decisions you can with your financial resources. And we look forward to talking with you next time. Take care and all the best. Bye.